Welcome to the Clark-Smith podcast. I'm very excited to have Kevin Murphy with me today, a fintech executive that's seen multiple turnarounds under private equity. I'm very much looking forward to this conversation, Kevin. Thank you so much for joining me. Uh, the main part of our conversation today is going to be around what it's like operating under private equity in the fintech world, and particularly in that turnaround type environment. But for people that don't know you, perhaps give a little bit of an introduction to yourself and what you've done.
Great. Thank you, James. And I'm delighted to be with you this morning. Looking forward to our conversation and hopefully of value to your viewers. So, my background is in retail banking, originally Irish, and spent the first 25 years of my career in large banks and ended up as MD of Bank of Ireland's cards and loans businesses operating in UK, Ireland, and also in North America. So, really solid grounding in retail banking. And the last period there was focusing on payments and probably came to a realization that was the part of banking that I liked the best. And then about 10, 12 years ago, excuse me, I decided that I wanted to go out and explore the world of private equity in conjunction with payments. So took it on myself to start building up my PE network, particularly in London. I was living in Dublin at the time, and left Bank of Ireland and started working independently. And my objective was, and actually still remains, to be the CEO of a payments business, internationally orientated, owned by private equity for 3 to 5 years with a turnaround type scenario. And I've done that now a number of times. And I think got reasonably adept and experienced and battle scarred from working with various PE funds and hedge funds, and also always in that payment space.
Hmm.
So probably originally it was in card issuing, consumer lending, the more traditional type world of payments. But then as the fintech boom came in, kind of ended up going along on that ride as well, which has proved to be interesting in lots of different ways. So that's my background. Now based in London, recently just finished as Group CEO and MD of an Australian payments business, which operates globally. And now looking to see where I will take my skills and expertise next over the next year or two.
Interesting. Thanks for that, Kevin. I'm always curious, after a long period in sort of more traditional core banking, what was the motivation? What drove you down this route? In chalk and cheese, night and day, in terms of the difference between a private equity owned organization and I suppose the more traditional banking world.
Yeah, so I
What
had
drove you
done
that way?
Yeah, I had done obviously 25 years, as I said, in traditional private bank, retail banking. And it was interesting and I really enjoyed my time. But I had a couple of experiences around the time of the financial crash when I was with Bank of Ireland engaging with private equity funds. In particular, we were selling a business that I had taken on a leadership role on in America, which was an FX payments business, and engaging with the PE guys who were doing the roadshow and the due diligence, etc. Just got to learn a bit more about how they operated and what they were doing and the types of businesses they were involved in. And I just thought that's very dynamic. It's very fast paced. They're doing some interesting stuff in payments. And I just felt then there was an opportunity for me to stretch into that space. And I think I'd had enough of large corporate retail banking at that stage, and the financial crash had shattered lots of our illusions. So it was okay. This is quite interesting, and we could talk in a while about some of the stuff that I've done in payments since. I think it has absolutely ticked the box in terms of interesting, and it's taken me all around the world, which I wouldn't have expected, and into situations and scenarios that have been just completely different than operating in your traditional, big retail bank. So it was that experience of engaging with them and then just spending time and building a network. I decided that that's where I wanted to focus my time.
And what about the turnaround side of things? Was that just a natural progression because that's what the PE firms were looking for, or was it a conscious decision to go into that sort of more change transformation type environment?
So it wasn't a conscious decision. It was more by accident, but then later on by design. So when I left Bank of Ireland, the first PE business that I took on as CEO was an Irish consumer lending business linked to a Spanish consumer lending business. And that business was actually, when I took it over, it had no regulatory license. It was operating under an exemption from the CBI. It wasn't doing any new lending and it was closed to new business and was basically a rundown, very large portfolio of consumer lending. And yet I could see that actually, if you look beyond what was presented in front of you, there was a turnaround situation whereby we could go and get a regulatory license. We could repair the front end origination part of the business, and we could become a player in the market. And that's actually what we did. It took us probably 2 to 3 years to get two regulatory licenses, deal with large tech issues, and historical legacy remediation issues, but effectively bring a business that was that was bought as a rundown closed portfolio to stabilize it and then bring it back out into the market and open it up. And that business now has gone on from strength to strength. I left there, I think, in from memory, 2017. I decided early on in 17 that I wanted to try and do a management buyout of that business because, and this is an interesting part of the PE world, that business was bought as a closed portfolio, so was sitting in a closed rundown credit fund and was in the wrong place. And so I wanted to do a management buyout, and we didn't eventually get it across the line. And I was happy to leave at that stage. I'd done 3.5 years, and I felt I had completely turned the business around. And I think to your point, then that opened up for me. Well, actually, there's a very interesting turnaround situation, and I've ended up in those type of scenarios, and that appeals to private equity because typically if they can they want to buy reasonably cheap, look at something that's maybe distressed or maybe has been a bit of a car crash or has had significant issues, and then bring in seasoned operators who can say, okay, I can see it's a bit of a mess at the minute, but let's fix it and let's create value and then let's do something with it. So
Mm.
that has tended now to be where I operate, not exclusively, but particularly in areas where there's heavy duty regulatory presence as well and a lot of regulatory engagements, and that's not for the faint hearted, to be honest. So it wasn't by design, it was actually just the way it's operated, and actually I think I quite enjoy it, although it can be fairly taxing.
Yeah. And obviously you've done this now multiple times. So I'd imagine that you've sort of built playbooks and frameworks of how to operate in that environment. So what's worked for you and when you're, assessing whether it's an opportunity that you want right through to kind of how do you start that process of turning it around?
Yeah, I think the pre-appointment phase is really important. So typically when you go in as CEO of a business, you get an opportunity to have a good look from the outside at the business. If it's owned already by PE, they'll open the books to you, so you kind of have a good idea of what you're going into. But if it's not owned and you're trying to acquire it in conjunction, say, with a fund, then you do as much external DD as possible. The thing about this, though, is you never can find everything. So, I've gone into situations where I thought the problems were that big, notwithstanding I had done maybe 6 or 8 weeks work in terms of looking at it. And then within a month realized actually the problems aren't that big. So I wouldn't say that there's a particular playbook. And, lots of funds when they're buying businesses will get the big accountancy firms to do commercial DD and origination DD. What I like to do is talk
Mm.
to people in the business if you can get access to them, and talk to people around the business. And there's always people around the business who've either maybe recently been there or been clients or connected with it that will speak to you. And they'll speak to you openly. And you then start to get a sense around some of the issues that you're going to be facing in the business. So that's, I wouldn't say I have a playbook, but I try and invest as much time as possible before you go in. And then when you go in on day one as CEO, you've got to have a message. So there's no point in my mind going in on day one and saying to all your stakeholders, well, give me 90 days and I'll come back and I'll kind of tell you what the story is. You can take your 90 days to uncover issues, and maybe we'll talk about that in a while, but you've got to have a message, particularly if you're going into a business with a couple of hundred people.
Mm.
They're looking at a new CEO coming in. Perhaps the business has been pretty challenged over the last period of time, and they're looking for clarity and direction. And even if your clarity and direction is just a plan for 6 or 9 months, as in we just need to stabilize the ship, or we need to get through a particular remediation issue, or we need to just hit our numbers in 6 months, just giving people a plan and a sense of purpose I've found is very important. And just communicate that at pace. I think the other thing is honesty as a new CEO is really important. You don't
Mm.
have all the answers. And you can't be expected to be. But what you can do is talk to a business, and particularly the colleagues and the key stakeholders around, look, this is what we're going to try and achieve over the next 6 to 12 months. And then you get in and you try and find the problems and work it. So I wouldn't say I have a playbook as per se. I think I have a lot of experience. And one of the things, James, that I'm really big on is taking an early assessment of the skills and capabilities within the business. And then I have a large network of experienced payments and financial services professionals. And when I go into a business, I'll take a quick recce in terms of, for example, recent business I went into had a very particular operations issue in one of its subsidiaries. And I knew a colleague of mine who'd worked with me in a number of different businesses, John, and I just rang John and said, "Are you up for an assignment? I've got a problem over here. I can't stretch and spend 6 weeks of my time on it, but can you come in and look after it?" And it's bringing in people. I call it the grey hair brigade. And it's just people who have a lot of experience, and they're not necessarily looking for a long-term contract, or they're not looking for a career path, but what they're interested in doing is interesting work. And I'm very fortunate that I have a core team of colleagues
Mm.
who, are silly enough to answer the phone when I ring. And as one of them says, I'm still stupid enough to keep answering the phone every time you ring me, Kevin. But they're interested to come in and take on difficult assignments. So, there's a cohort of people that appeals to. And I
Yeah.
think back to your question, then, you know, part of the playbook is bringing in experience when you don't see it. Because at the end of the day, as a CEO, you're just one person.
Yeah. 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 And typically, I mean, we're talking about the existing business, and it sounds like there's a lot of focus from you around the people side of things as well. What do you typically find from the teams, the people that are already existing in the business? Is there an awareness of the issues? Are they head in the sand? And then I suppose there's a mindset shift and change that they've got to um, get on board with, or is it a case of get on board the train or get off?
Well, it's certainly an element of that at times in terms of the business is going to go in a particular direction, and it's not for everybody. I must say I have found people, every business I've gone into, to be welcoming. Frequently, as I said earlier, they've been through a challenge period of time, and they'll have a view on the issues facing the business. Probably what they don't have is objectivity from the outside. So, if you imagine if you're somebody working in a business 50 hours a week, you're working really hard, you're doing your best, you may be in a particular function, you're trying to move that along, and you may be wondering why the organization is challenged, and particularly then I can bring an outside perspective to the business in terms of, look, this is what it looks like from the outside, notwithstanding everybody in here is working hard. And whether that's, a massive share price reduction, or whether it's lack of interest in current investors, help them understand the picture from the outside in. Um, the people internally typically are very open around the challenges in the business, and I speak frequently about uncovering landmines.
Mm.
So landmines are issues that are buried in the business that you really want to find in the first 3 to 6 months, so that you can kind of get a full recce of what it is you're dealing with. And colleagues in the business then are typically very good once you build a rapport and honest around the issues that are in the business. Um, Not all of them will be fit for purpose, typically for the journey the business is on. It may involve a level of downsizing or reskilling, but I think once you are transparent with people and I think over communicate around the plan and what it is you're trying to do, and then engage with people. That's the best methodology for working with new colleagues in short time period.
And that's, I suppose, pushing down into the organization, communicate, look at what the problems are, where the skill sets are. But what about sort of upwards to ownership, whether it's the private equity or other investors, because they'll have the numbers to look at. Yeah, how will that sort of communication process go and stakeholder management, I guess?
Yeah, that's a really interesting question, James. And if I reflect on the 3 or 4 businesses I've been running since I left Bank of Ireland, I've had very different models at play in terms of let's call it investors, the investor community, PE funds, etc. I've operated from PE funds that I really only spoke to once a month, and they got the board pack and they were happy with that and they were happy with the direction. They were available if I wanted them, but effectively as a supervisory board, I only spoke to them once a month. To funds where and shareholder stakeholder groups that you're speaking to literally every single day and are quite hands on. And initially, when I started turning around businesses, I kind of liked the model where I was basically myself and the team were left alone to get on with it.
Mm,
But more and more, actually, I value those funds that have significant operating capability that can be brought to the table. So, a couple of years ago, I was involved in a business and took on an interim CEO role. And it was obvious to me pretty quickly that there were some serious issues in the business. And being able to go to the fund and articulate the issues, and then they were able to bring their operating partners and skills and expertise to the table was definitely a huge benefit.
mm.
And I've worked from the mid, let's call it the mid-market funds who typically don't have that bench to the large funds that do have that bench, and it adds a lot of value.
Yeah.
And then you find yourself actually talking to, let's call it PE representative fund representatives almost on a daily basis. So you're really working as a team. And I think that works really well as a model. So notwithstanding if I go back 8 to 10 years, I prefer the model where basically I was left alone. I actually now prefer the model where we work really closely. And what that means is that there's no surprises. You've got a really good line of sight and understanding on what the fund are trying to do. And it's very clear and it's very direct. And so you still have your formal board meetings and maybe your weekly catch ups, but actually you're engaged with them on a regular basis, whether that's the operations guys or go to markets or the regulatory guys.
Yeah.
That whole area of stakeholder management, I was explaining to one of the business units I spoke to a couple of years ago. They, I think they thought that the CEO at the top of the business was like the top of the pyramid, and I was explaining to them, yes, it can look like that, but actually around the CEO and above the CEO, there's a massive amount of people who are almost bearing down on top of the CEO. So in many ways, you're in the middle. You've got to communicate down into the business and out to clients, but also you've got to engage stakeholders, whether it's the fund or regulators or key clients or investors. There's a huge amount. I would say 50% of your time can be actually engaging with people who are invested in some shape or form in the business rather than the people working in the business. And
Yeah.
just keeping that balance can be difficult because when you go into a business and you've got 57 million issues, I certainly like to dive in and get the issues fixed, but you've got to allow enough time to be able to just sit above that and then engage with your stakeholder community.
Yeah.
So that's certainly something I've had to refine over time. And what I have learned is putting in place some structures around that is really important. So, having an internal comms person, just even as simple as managing your diary so that your diary doesn't get eaten up by all the things within the business, and you have enough time and energy to actually think about the business objectively and engage with stakeholders.
Yeah. And in those early stages, in those first sort of 90 days, I'd imagine you've got probably a lot of um, equity in terms of being able to highlight issues that they might not be aware of, and almost a case of let's get the bad news out as much as possible early doors so that we can start turning things around and fixing things. But that can also be a tough pill to swallow for people because they might not have seen it. How's that? Because there's obviously pressure from that investor group.
Yeah, it reminds me of when I worked in retail banking. We used to call it the new branch manager
Mm.
concept. The new branch manager goes into a branch, finds all the rubbish, opens the drawers, and basically puts it all on the table, and gets a clear deck then for going forward. Because there's no point finding a problem after a year because you own it then, versus actually the first 3 months. The way I like to think about it is if I'm going in, and particularly if I'm bringing in maybe a couple of people to assist me, or I'm using some of the funds capability, we've got to get to the key issues very quickly, and typically they'll be known, but not always, or there'll be a key issue and there'll be a view on an issue, and there'll be a perspective that we're going to fix it in a particular way, but actually you may find that that's not the case.
Mm.
And I had recent experience of that in terms of engaging with a board, a large issue within a business, probably the largest issue within the business. We had a plan and we expected that we would be able to fix that issue in a particular way, and having to go back to the board after 3 or 4 months and say, after doing a huge amount of work on it, guys, I know I told you that I thought we could fix this, but actually we can't, and we have to take a different route. And I think once you're able to then articulate your position clearly and do good stakeholder management, people will listen to you. But I think it's just an important concept around, your first, say, 90 days, give or take, try and find all the big problems that are
Mm.
there. And you do that back to what we were saying earlier, just talking to colleagues. So
Yeah.
some of them will be very obvious, but actually some of them won't be that obvious. But colleagues know about them.
Mm.
And so you've got to get them out, because if you're going to put the business on a firm footing, particularly a turnaround situation, you just need to know what you're dealing with, ideally, and the depth and the scale of the issues, so you can put a concrete plan in place and then try and move it forward. That
Yeah.
doesn't mean you can't deal with issues, James, as they arrive subsequently down the road, because there always will be issues. I always say that the easy problems are always solved on their way to the CEO's desk.
Mm.
It's only the real sticky, messy ones land on the CEO's desk. But the more of the issues you can identify up front, just the better chance you have of putting together a comprehensive plan,
Yeah.
and keeping stakeholders online. And I think stakeholders will understand that in the early days, you are doing an amount of rock lifting and finding what's underneath it. And I think they kind of expect that with a CEO. You're not going in to just sit smoothly and just glide along. You're going in to see, okay, what are we dealing with here? There's probably a lot of money invested in this business. What are the issues that we've got to grapple with? And then once we have a good sense of them and we go and find them, then how are we going to deal with them?
Yeah. It's interesting you mentioned there about changing track on initial plan of what you think, okay, we can go down this route, and actually you get 3, 4 months down the line and you say that's not going to fix the problem. I mean, I've worked with private equity. I know investors that they're an impatient bunch. How does that communication piece happen? And I suppose what are the pitfalls of that? Because that could be a delicate time, I'd imagine.
Yeah, you're right. It can be, and you're right. PE funds typically are impatient and they want stuff fixed quickly, and of course they want value created quickly. I think and it maybe comes to what skills you need to have to be successful in this world versus maybe other worlds. Independence, objectivity, resilience, the ability to be able to just make the hard calls, whether it's on people or issues or businesses, and to have that on a fact basis. And the one thing that PE fund professionals are is they're very, very bright. And so if you come to them and say, here's a situation, here's how I see the situation. Here's the facts and parameters around it. Here's our options, and here's my recommended course. They're very open to engaging in that. And I think if you do that professionally and in a constructive way, you'll get constructive engagement back.
Yeah.
And at the end of the day, we're all about the same objective, which is saving the business potentially, and then creating and generating value. And even though the stories that you're bringing may not, or the situations that you're bringing may not be very pretty, having an objective assessment and then a set of recommendations and a route map out of it is always the right way to go.
No.
Typically, you've got to pick up the phone sometimes and say, "Hey, we've got a serious problem, but I'm on it. I'll be back to you in a week or 2 days or whatever with a plan." And they appreciate that.
No.
Might like it at the time, and I've had a few testy phone calls, but that comes back to your own independence and your own resilience and ability to actually deal with pretty messy situations at times.
It's an interesting point talking about the investors and I suppose their profile. I think someone articulated it to me very well. They could be extremely high IQ, but maybe lacking in EQ. And that can be difficult for the CEO running a business because at the end of the day, it's a lot about the people as well. So talk to me about the brutal truth about operating under PE.
Yeah, I think that's a very good description. I mean, I've really enjoyed working with many PE professionals, and I've learned a huge amount from them. I've learned how to make money. I've learned how to deal with situations, and we've grappled with some um, tricky scenarios. That said, I wouldn't necessarily want to go for pints with them. But they're very good professionals, and they are very successful typically at making money. The CEO in many ways has to be a buffer because it's a people business. And clearly, then once you're operating as the CEO within the business and you're engaging with your team and colleagues across the business, you've got to be open and you've got to have a very good level of engagement and I think listening and understanding of the issues that they're dealing with, and maybe more patience displayed than you would maybe typically want. And I think it's quite a different dynamic frequently when you're working with the PE guys who are, look, it's all about the numbers. I remember being asked at a town hall when I was back in Ireland 7, 8, 9 years ago. One of the colleagues um, in the open question asked, what does the PE fund think about us? And I said, well, I'm really sorry to tell you, they don't think about you at all. They don't think about you. They don't think about customers. They don't think about the community. What they think about is the numbers. And ultimately, at the end of the day, what it boils down to is your business is a set of numbers for them as part of a portfolio of investments. And of course, they want you to do well, but at the end of the day, they will be driven by the numbers. So the CEO has an important, almost translation
Mm.
role to do there in terms of working with the funds and making sure that the numbers are green, and that the fund is satisfied and you get investment and all that good stuff, and then managing the message maybe differently into colleagues who are working very hard within the business but just don't have the understanding around the overall objective position of the business and how the fund looks at it.
Yeah.
So it is quite, you do end up on different points of that engagement model, working with some exceptionally bright people in the funds, who are very, very good at understanding payments businesses and strategy and making money and investments, but probably would not be good at engaging with 100 people in the business. And you've got to be able to manage both sides and effectively play both games.
Yeah. And it's a difficult balancing act, like you say. I mean, what in your mind, having done it, multiple times now, what does it take to survive in that world?
Yeah, it's not for everybody, James, and there have been days when I've questioned what I'm doing in this world. But I think on balance, I've definitely enjoyed it. And as I said earlier, the opportunity to work with funds, and whether it's PE funds or hedge funds, for me has taken me globally, operating in pretty much every continent except South America. And it's been really, really interesting. But to your question, what does it take? You're effectively largely operating as an independent operator. So you've got to have a level of resilience. You've got to have a level of independence. These are typically not long term assignments. They can be, but typically not long term assignments. They're very high impact. And so if I think about the last business I was CEO of for 18 months, I mean, that was massively high impact in terms of the challenges we had to deal with. I suspect I was working 80 hours a week. I was flying every week somewhere, and it certainly takes a toll on
Mm.
you, particularly if you're running an international business. So you do have to be careful at minding yourself. You've got to be independent. You've got to have some very good advisors as well. And I've been fortunate that I've worked with a number of advisors that help me when I go look at a business and then help me when I come into a business and just give me that, they're not on the board and they're not in the business, but give me that objective perspective
Yeah.
and also somewhere for the CEO to go and speak to. Which is, you may be dealing with some really messy problems within the business. You're not ready yet to kind of give a plan or talk to the stakeholders in detail. So sometimes you need somebody to go and talk to
Mm.
and say, look, I'm really grappling with this. And I'm very fortunate that I have one or two key advisors that I trust and have been with me through various iterations.
Yeah.
So,
Yeah.
this world is not for everybody. I would articulate it as being a very exciting, dynamic, interesting world where funds are looking at businesses, buying businesses, implementing aggressive value creation plans. But it can be a pretty challenging place to work. You need to be resilient and independent. And it's definitely not for everybody. Uh,
Yeah. Yeah.
and it's also not a world typically where I would say you can build a career of like 20 years all in one company. Some people do that, but certainly from, talking to other colleagues who do similar things like me, we tend to take on businesses for X number of years. It's probably high impact leadership. And then that comes to a sale or a divestment or something similar. And then you take a period out. The one
Yeah.
thing I have learned is that when I finish in a role, which typically has been pretty intensive, I now take a couple of months off. I'll still network around the industry, but I don't dive into my next role because when you've been spending 80 hours a week trying to rescue a business or turn it around or traveling internationally, and it's just all encompassing, you do need a period of time to just almost detox from it and
Yeah.
get yourself ready for the next challenge and then
Yeah.
also find the next challenge.
Yeah, absolutely. We'll come on to finding the next challenge and how to go about that process. But you've said obviously P is not for everybody. I think the PE and venture capital has been glamorized in certain ways. People can think it's easy money, but what would you say are the common misconceptions that people have around private equity?
Yeah, certainly what I find is I get colleagues and former colleagues from large institutions maybe coming out after 20 or 30 years and saying, hey, I'd love to run a PE business. My answer to that is, don't we all? And I think they think it's just easy to rock up to a fund and say, hi, I'm an established MD or a CEO or a CTO, and I just, I'm looking for a job. Um, that isn't the way I found it operates, and people need to be prepared to put in the grind and engage with funds. Like I'm meeting a fund next week on a particular opportunity, and this will be my fifth meeting with them. And I've made presentations to them and I've discussed it with them, and there's a lot of engagement. So I think people need to understand that this is not a straightforward model to operate in. Yes, you may end up being part of a portfolio business, maybe through acquisition. But if you're coming out of, for example, one of the large banks or a large corporate and you want to go into the PE world, there is a period of adjustment, and you do have to think really carefully and learn from the experience of working in those businesses. It can be quite different than operating in different types of businesses.
What's the biggest difference would you say for someone coming out of a corporate environment going into that world? Is it the pressure? Is it the pace, the intensity? What's the one that catches most people out?
The one that caught me out early on was decision making.
Mm,
And it caught me out early on, James, because I was used to a decision making model in Bank of Ireland where, any material decision had three stakeholder groups, 14 functions looking at us. There was, as a senior executive, even you kind of think, did I ever actually make any decisions on my own? Because every decision was stakeholder managed all over the place, such that everybody kind of aligned on the decision. Um, my very early experiences in PE were as the CEO of a PE business, you have a huge amount of autonomy. And particularly in that kind of a business where the PE fund were not in the business on a day to day basis, actually, the decisions land on you very quickly. And as I mentioned earlier, they are the hard decisions, not the easy decisions. And so, decision making capability and the pace at which decisions have to be made was the big learning for me early on. So,
mm,
it was a case of you now have this business, you're the CEO, you talk to the fund, maybe on a Friday you might have a catch up call. But other than that, you might speak to them once a month. And it's your baby, and you've got to make the decisions, and you've got to decide the approach to the regulator or the technology or whatever the issue is. You don't have 14 other advisors, colleagues around the business at your level through stakeholder groups. And that is and has been the big, big change that I felt. But I've grown into really enjoy it. So I
mm.
think now if I went into a large corporate, I'd probably die of suffocation. Whereas now I really enjoy the ability to actually make these decisions, make them reasonably quickly with imperfect information, and then execute and move on.
Yeah.
But that was certainly the big learning very early on. And I remember, like, I was working for Apollo, the PE fund, and having some conversations with them around some significant investment questions. And their response to me was, well, basically, if you think you need to do it, just do it. And I naively said, well, will I set up a meeting and get some presentations? And this was, I think, a 250,000 investment decision. Will I set up some presentations and we'll go through it? And the answer from the partner was, no, no. I said, do it. And so it was a real learning point around, wow, this is very different.
Mm,
This is very different. I have the autonomy to get on and do this. I can make the decisions. I can drive it forward. Of course, you've got to make as many of them as right as possible and keep the fund updated. But I didn't need to talk to 25 people to do that, where it's
yeah.
been very different from working in a big corporate.
Yeah.
And so it's linked to that then, James, is pace.
Yeah.
So we typically talk about the funds have maybe a 3 to 5 year timeline. So they buy a business to get into grips with it. They're already thinking about their exit. And the question I get asked frequently when I'm presenting propositions to funds is, well, if we buy this, who's gonna buy it from us in 5 years' time? So the day they buy is the day they're thinking about selling, and so you've a limited amount of time to actually make a difference and
Mm,
get the business into the right shape such that they can sell it and create value.
yeah.
And
Yeah.
so pace is hugely important, and I would say that certainly from my last 10 years in PE versus, say, my previous 25 years, accepting that I was kind of growing into my career, the pace of decision making and work is much, much faster.
Yeah. Yeah.
Now, I like that at this stage. I've enjoyed it and I feel very comfortable in it. But again, it's not necessarily for everybody.
Yeah. You've obviously got your network of advisors and people that you've worked with that you can parachute in depending on the situation. But if you were in a scenario where you didn't have that and you were looking at someone new and different, how would you assess or test for the right sort of skills and attributes for being able to operate under that decision-making pace and intensity?
Yeah, that's a really good question. I mean, if I'm hiring let's say, a senior exec to come into one of the portfolio businesses, I personally, I don't like long interviews,
Mm,
but actually, if I do a short interview with somebody and I think, okay, they're interesting, I'll try and spend a bit of time with them, if possible, even bring them into the business for like even for a couple of hours and engage with them maybe on some of the issues we're dealing with. I will look though to see where they have worked in dynamic businesses And typically, if you're coming out of a large corporate, you may have fantastic credit skills or risk skills, but actually, have you got the appetite for this kind of an environment? And I think the other thing that P company portfolio companies frequently have is they don't have everything all neatly formed. So
Mm.
if I think about, I brought a colleague into a business a couple of years ago, and he came out from one of the very large banks. And as you'll know, everything works. Well, it doesn't work, but everything. They've got all the functions, they've got all the policies, they've got all the procedures. They've got all the HR departments, all there. And then you come into a business which is owned by a fund, maybe has been through the wars, and you suddenly find there's loads of gaps.
Mm.
And it can be overwhelming, and it's not everybody can cope with that. So in ways in trying to just test and learn, how do you think they could cope with an environment whereby, if they're coming in, for example, as a chief risk officer, this business may have a few warts on it, and there may well be processes and procedures that we should be doing from a regulatory point of view that we're not. And how will he or she deal with that? I don't always get it right. I spent quite a bit of time 5 or 6 years ago onboarding a chief risk officer to a business that was running in Europe, and just making sure that he understood the issues we were facing. And he came in, and 60 days later, he was gone. And of course, that is embarrassing in front of the regulator,
Mm.
because your chief risk officer comes in, gets approved, and then takes a look left and right and decides it's not for him. And I think actually that was more a factor for him rather than the business, because we subsequently got a very successful chief risk officer who came in and was very comfortable. But it's just not for everybody to be exposed in that way to, let's call them, businesses that are going through development
Yeah.
versus businesses that are, have been established a long time and have all the policies and procedures, and being blunt, have hiding places.
Mm.
So, if you're, back to my point around individual autonomy, if you're a CRO of a PE portfolio business, like, you're on the line, you're sitting in front of the board, you don't have 400 people around you, whereas you're in a large corporate, you've got hiding places.
Yeah.
Uh,
Yeah.
and that's not everybody's cup of tea.
Yeah. Yeah. Absolutely. Interesting. Thank you for that. I mean, you obviously mentioned that you take some time out after turning around a business, but do you just wait for the phone to ring for the next PE opportunity, or do you have to be quite proactive in terms of finding that deal flow for them? How does that process work?
Yeah. So my experience, some people are different, and I'm jealous of them, but my experience is, if I sit and wait for the phone to ring, the phone doesn't ring. Um, Whereas if I get out and engage with the industry, both the payments world, my network, and also PE funds, I can make stuff happen. And so that's typically what I do after taking a break coming out from a business. I typically then start to think about, well, how do I identify a business or a set of businesses that I think would be of interest to PE funds, and then bring that to the fund. So, you're going to have a pretty short conversation if you rock up to a fund and say, "Hey, I'm an experienced CEO. Like, give me a job." That's going to be a 5 minute conversation. However, if you are embedded in your individual industry, like I am in the payments industry, and you can see potential opportunities that, because you know the industry, funds don't see. And remember, a lot of these funds are operating across different
Mm.
industries. So if you can identify an opportunity that, look, here's a business that's maybe underperforming, and I think I know how to fix it and put it on a growth path, or here's a potential carve out, or, just by talking to people in the industry, you just hear stuff and you think,
Mm.
okay, that could be interesting. I wonder, is there an angle there?
Yeah.
And then what you've got to do is you've got to maybe work with one or two colleagues in terms of, actually, let's find out a bit more about that opportunity. Let's see whether there's an angle on it, and that angle is interesting. And then let's see whether we can take it to a fund and see whether the fund is interested, and effectively get a project up and running.
Yeah.
That takes a lot of time and energy. Um, that said, I personally have found it to be quite successful, and I'm currently engaged with a couple of funds on a couple of different potential opportunities. You do end up spending a lot of time And then at the end of it, I mentioned earlier that I'm having my fifth meeting with a particular fund. They could turn around at the end and say, this isn't for us.
Mm.
So you've got to walk away or maybe find somebody else that it's for. So this is a challenging part of working within
Yeah.
PE, particularly if you're trying to find your next role. And I really only take on CEO roles, so that's what I'm looking to find.
Yeah.
But I found my best engagement with funds and investors is around saying, look, I think there's a particularly interesting business here. I've got an angle on it, or I have an in, or I see something maybe that is not obvious to somebody else. And I think I can then engage and package and develop a little proposition around it and then bring it to a couple of funds.
Yeah. Yeah.
My experience of working with funds is if you bring an interesting proposition to them, you'll always get 30 minutes.
Yeah.
And if you can pitch your proposition in 30 minutes, then you'll see whether you can get engagement or not. But then you've got to do the work around, well, let's say I identify a particular business that I think is potentially transactable. Let's say it's 200 million in value and it operates in Europe. I then need to say, well, which fund is actually that going to be of interest to? So they may not do Europe. This check size
Mm.
might be too small. They maybe don't like turnarounds. Maybe they've maxed out on payments or they're just not interested in the space. So actually, you're trying to, on the one side, identify businesses that you think there is potentially a transaction on. And on the other side, you're trying to identify a fund that actually you think that would be interested in it. Now,
Mm.
there are companies that operate in that space, effectively like origination type companies. And I have engaged with one or two of them and I've found them to be very useful. But frequently, I try and do this on my own with one or
Yeah.
two key advisors.
And what we've seen, what I've seen with private equity and investors over the last couple of years, with inflation, the interest rate rises, the uncertainty around sort of political, geopolitical situations, is that sort of um, ideal deal kind of structure and size is narrowed. And as we get later into fund cycles as well, you know, yes, there's capital to deploy. And I know from some of the investment directors that I speak to that there's, pressure to do more deals, but almost that bullseye sort of deal is getting narrower and smaller. How does that impact?
Yeah, it makes it harder. So I
Mm.
think you're absolutely right. And when you talk to everybody, they say, "Oh, well, there's loads of, money out there. People are keen to do deals." That's true. But I think it's certainly my experience. It's harder to get deals agreed than it was a couple of years ago. And I think funds, notwithstanding, they may well be sitting on significant amounts of undeployed capital, have got tighter in terms of where they want to deploy. And so, your work that you do as an individual in terms of bringing a proposition just needs to be very well thought through
Mm.
to get traction. I definitely think it is a bit harder than it was. Um, my experience, though, is that good, solid propositions will get a hearing. But you also then run the risk around, you can spend quite a bit of time with a fund and then they're very interested in the proposition, but they bring it to their investment committee, and then something else is going on in their fund somewhere or in the world, and it just, while it might be very interesting, they're not going to pursue it.
Yeah.
So there's a lot of time and energy goes into that. I kind of enjoy it because I like engaging with them, and it always opens up new opportunities and it expands your network, and you learn more about how they think about opportunities. But I would say definitely their criteria for assessing and making investment decisions are tighter than they were a couple of years ago.
Yeah. Do you think that's changing at all? There's, interest rates, we have a sort of landing space as they come down a little bit. Inflation is mostly kind of past the peak. Do you see that changing? Talk about IPOs, Klarna, and things like this, and monetization opportunities. Yeah. Do you see that loosening?
I suspect it may well do, James, over the next year or two, but I personally haven't seen it on my sample of individual projects that I'm working on. I haven't seen it yet. But what I do see consistently is that well packaged and well thought through propositions to PE funds and hedge funds get attention.
Mm.
And so then it's a question of can you get engagement and can you actually move forward and execute on a transaction. But it's very much around if you're an individual operator like me and you're trying to bring opportunities based on your industry experience, you've got to do the groundwork and meet the people. So if I identify a particular business that I think, okay, that's potentially going to be transactable or there's something interesting there, you've got to put in a lot of groundwork yourself and it's on your own cost.
Mm.
And that may mean you may need to travel somewhere and you may need to meet people and prepare the decks and then try and find a fund. So there's certainly my experience is there's a lot of work involved. And then in a market which is tighter, that becomes harder. So I don't yet see the market loosening out, maybe over the next year or two, but I haven't seen it yet. And so that means as an individual, you probably have to pedal harder.
Yeah, yeah. Interesting. Interesting.
Like I think James, when I think about some of the valuations and money that was thrown around in the fintech boom, and I look at some of the transactions that went on at that time, I think it had gone way too far. I
Yeah.
remember speaking at a conference probably 5 years ago when the fintech boom was flying and it was all around market share and just revenue and not the bottom line and saying, well, look, I'm a bit old fashioned. I like profit and I like cash, and almost like nearly getting laughed at because that wasn't the
Wasn't the need, yeah.
mantra at the time. But I think a lot of people have been burned, and that is now the mantra, and it's very much around, you know, what I call good business fundamentals. And if you've got a good business story, and if you think you can execute on well and you can package that up well, you'll get attention. But
Yeah.
you'll get 57 million tough questions, and that's actually part of the enjoyment of working with funds. I was presenting to an American fund on a particular opportunity yesterday, and they just came up with some really intelligent questions. And that's back to our point around these are really smart people
Mm.
investing other people's money, and they're good at it. And so that whole process is very interesting when you get like really clever questions, and then you have to go away and say, okay, I need to think about that. But that refines your pitch.
Yeah.
So it's a very iterative type process, but it can be very time consuming, and you're doing a lot of this on your own time, trying to get a transaction across the line potentially, or trying to get engagement from a fund.
Yeah. No, it's interesting. I think you're absolutely right. You always try to put it in their terminology from their perspective. What are they going to get out of it? It's not just you see this opportunity, it's how can you create value for them, because obviously they need to create value for their investors because it's about raising the next fund, and
Yeah, and I was
that's
talking
how
to
it
a
goes.
fund director, I think, recently, and he was saying to me, Kevin, I look at 100 businesses a year. So, how, if I think I've got something really compelling as an industry professional, how can I get the fund attracted to it? So, I've
Mm.
got to put a lot of work into it to make sure that when I get that 30 minutes or an hour with a fund, my pitch and my presentation is as good as it can be. Because, they have another three this week. They just have a flow of opportunities coming in. But I've found that if you do the work and you know what it is you're presenting on and you're pretty adept at answering their questions, you'll get traction.
It's good. It's good. It's good advice. It's good advice. Kevin, thank you so much for your time today. It's been thoroughly enjoyable and interesting just getting to understand the world of what that looks like in a turnaround scenario, and I suppose the pressures that come that a lot of people don't really talk about. So thank you so much for your time today. I really appreciate it, and look forward to continuing our conversation at another time.
Thank you, James. I really enjoyed the conversation and hope we got across a balance between, it's tough and it's challenging and it can be hard and it's dynamic, but actually it can be really interesting and you can end up with really interesting situations and businesses and learn a lot and develop and obviously make a few quid as you go along. So there's a balance here and hopefully we've got that across and I've enjoyed the conversation very much. Thank you for
Brilliant.
the invitation.
Thanks, Kevin. Thank you.